Microsoft just cut 4,800 jobs. In the same 12 months, it committed to spending $175 billion on AI infrastructure. That is not a company in trouble. That is a company in trouble on purpose. Two-thirds of those layoffs landed on Xbox, a division whose new CEO told her own staff the business cannot continue on its current path. Meanwhile, Microsoft's cloud arm just crossed $100 billion in annual revenue. Its AI products passed a $37 billion run rate, and the stock posted the biggest single-day market cap gain in the history of the stock market. So which is it? Is Microsoft dying or winning? The uncomfortable answer is both at the exact same time, because of the exact same decision. Start with the money, because the money is genuinely staggering. Microsoft spent $41 billion on capital expenditure in a single quarter this year, most of it on the graphics processors and data centers that keep Azure's AI services running. For calendar 2026, the full year number was guided at $190 billion, then quietly walked back to $175 billion. Not because the company got cheaper, but because an accounting change let it reclassify some of that spending as operating leases instead of capital expenditure. Same buildings, same servers, same commitment. Just a different line on the balance sheet. Investors, for what it's worth, didn't seem to mind either version of the number. To put $175 billion into context, that's more than the entire annual revenue of most companies in the S&P 500. Microsoft is spending an amount larger than the GDP of New Zealand to buy chips in a single year, largely from one supplier. Roughly two-thirds of that capital goes toward short-lived hardware, GPUs and CPUs, that will be technologically obsolete in a few years, not toward buildings that will still be standing in 50. That's the tell this isn't infrastructure investment in the traditional sense. It's an arms race. And arms races are expensive precisely because nobody involved can afford to stop running. Which brings us to the layoffs, because on paper they make no sense next to numbers like that. Microsoft cut 4,800 roles in July, on top of a voluntary retirement program earlier in the year that saw more than a third of eligible employees take the exit. It followed a year that already included two separate rounds of cuts, one around 6,000 people, another around 9,000. Chief People Officer Amy Coleman told staff that AI is changing how work gets done and that everyday tasks can now be automated. Translation: the company is paying for its AI bet twice, once in capital spending and once in headcount, and betting that the second payment shrinks the first. Nowhere does that trade look uglier than at Xbox. The division is losing 3,200 jobs through fiscal 2027, the largest gaming layoff ever announced by anyone. New CEO Asha Sharma called it the most significant restructure in Xbox history and admitted the business lost 64 cents for every dollar it invested. 4 studios are being spun out or sold off. id Software, the studio that built Doom, lost roughly half its staff. One analyst put it more bluntly on live television, saying Xbox's gaming business has become almost irrelevant inside a company its own size dwarfs. Microsoft spent $8.1 billion buying ZeniMax and $68.7 billion buying Activision Blizzard to build a Netflix of gaming. What it built instead was a division now openly discussed as a candidate for a spin-off, propping up console prices that have risen 3 times in barely a year, while the actual growth engine sits 2 floors up in the cloud business. Gaming didn't get bad at Microsoft. Gaming got deprioritized, and there's a difference. There's a version of this story where the bet already looks like it's paying off. Microsoft 365 Copilot went from 20 million paid seats to 30 million in a single quarter, a net gain of 10 million seats in 3 months, the kind of enterprise adoption curve most software products never see in years. The National Health Service in England has rolled it out to over 500,000 clinicians and staff. KPMG has it running across more than 276,000 professionals. HSBC has 200,000 seats live. These aren't pilot programs anymore, they're payroll-scale deployments, and every one of them is billed monthly, recurring, and sticky in a way that a $70 video game license never was. Microsoft added 31 new data centers in a single quarter this year, bringing the yearly total to 88 across 5 continents, and still told investors demand was outrunning supply, forcing the company to shop for extra computing capacity from Amazon and Google just to keep up with its own customers. That is not the profile of a company hedging a bad bet. That's the profile of a company that thinks it's underbuilding. But it's also worth remembering Microsoft has been here before, on the wrong side of the trade. This is a company that watched the entire smartphone market get built by Apple and Google while it kept betting on Windows Phone, a platform that never broke 5% market share before Microsoft quietly wrote off billions and walked away. Satya Nadella took over in 2014 largely by admitting that mistake out loud and refusing to let it happen twice. Everything about Microsoft's AI strategy today, the multi-lab hedging, the in-house model family, the willingness to burn cash on capacity, nobody's proven they'll fully use. Reads like a company still haunted by mobile, determined not to be the incumbent that shows up late to the next platform shift. That instinct is probably correct. It's also exactly the instinct that leads a company to overspend, because the fear of missing the next big thing is a much stronger motivator than the fear of a balance sheet nobody outside the finance department reads closely. Now for the part that actually explains the stock chart, because Microsoft's shares fell nearly 23% in the first half of 2026, their worst stretch since 2022, before that record-breaking single-day surge undid most of the damage in one earnings call. What changed investor minds wasn't Xbox. It was Azure growth accelerating to 31%, then higher, and a very specific number buried inside the earnings report, a $3.2 billion gain in a single quarter from Microsoft's stake in Anthropic. Compare that to the $5 billion Microsoft made on its much larger, much older OpenAI position across the entire year, and you start to see the real story. Microsoft didn't just fund the AI boom, it hedged it, spreading roughly $5 billion into Anthropic in a circular deal that also commits Anthropic to buy $30 billion of Azure capacity, while keeping its 27% stake in OpenAI, worth an estimated $228 billion on paper, running in parallel. That word circular matters more than it sounds. Microsoft invests in Anthropic. Anthropic spends that money buying Azure compute from Microsoft. Microsoft books the growth as cloud revenue and the equity stake as investment income, twice profiting from money that, in a sense, never really left the building. The company is doing something similar with OpenAI and has now signed a multi-billion-dollar infrastructure deal with a third lab, Mistral, on top of building its own in-house MAI models under AI chief Mustafa Suleyman. Microsoft has also been quietly pulling OpenAI and Anthropic's models out of flagship products like Word, Excel, and Outlook, swapping in its cheaper homegrown alternatives, and reportedly training its own sales staff to talk customers out of relying too heavily on either partner. Satya Nadella's public explanation is that enterprises should never trust one model provider with their business. His private explanation is almost certainly cost. Every token run on someone else's model is a royalty. Microsoft would rather not pay. So Microsoft ends up positioned on every side of the table at once. Landlord, lender, customer, and now increasingly competitor to the very labs it bankrolled. That's an extraordinarily strong hand to hold if the underlying bet actually pays off. And that's the catch. Nobody in this story can fully answer yet because behind the record revenue sits a debt problem that doesn't show up cleanly on Microsoft's balance sheet at all. Analysts at Moody's have flagged roughly $821 billion in leases and future obligations across the major hyperscalers that haven't even started yet, mostly financed off-balance sheet through vehicles that let companies like Microsoft avoid the term debt while carrying almost exactly its financial risk. Just weeks ago, Goldman Sachs was gauging investor appetite for a $5.4 billion bond sale tied to a Microsoft data center project, part of a wider $250 to $300 billion wave of hyperscaler bond issuance expected in 2026 alone. A third of fund managers surveyed by Bank of America now name AI infrastructure spending as the most likely trigger for the next systemic credit event. Microsoft isn't reckless with this money. It's disciplined, cautious, and still exposed because the entire industry is borrowing against a demand curve for AI compute that everyone assumes will keep climbing forever. It hasn't stopped climbing yet. That's not the same as proof it never will. So here's the honest verdict. Microsoft isn't struggling and it isn't unstoppable. It's leveraged in every sense of the word against a single bet that AI demand outgrows its own staggering cost. Gaming got sacrificed for it. Thousands of careers got sacrificed for it. Even its oldest, closest AI partnership got quietly downgraded for it. And so far, the math has worked in Microsoft's favor by a wide enough margin that Wall Street rewarded the company with the single greatest day in stock market history. But leverage cuts exactly the same way in reverse. The company that spent $175 billion proving it believes in this future is also the company with the least room left to be wrong about it.